The main macroeconomic feature of the coming week is likely to be the annual Central Bankers Symposium at Jackson Hole, Wyoming, which will run from Thursday the 21st to Saturday the 23rd of August. For those who would rather listen to white noise than monetary policymakers, and I know some of you are out there, then the latest UK inflation and consumer confidence figures on the 20th and 22nd respectively may be of more interest, especially as the schedule for corporate news is relatively scanty. There are no statements due from any FTSE 100 firms, although it may be worth keeping an eye on the following sets of results or updates from IWG in Tribal on Tuesday the 19th, Costain and OSB on the 20th, and Hayes on the 21st. So given that, we're going to change perspective a little bit this week and look stateside, particularly as the debate over tariffs and their potential impact remains as relevant as ever. There are suggestions that a slight increase in US unemployment and the cumulative impact of inflation over the past 3 or 4 years are finally both catching up with the American consumer. Now, the US Conference Board's Consumer Confidence Index stands well below its post-pandemic high of 2021. The US National Restaurant Association's Restaurant Performance Index has ebbed too, and it sits at 100 right now, exactly on the dividing line between growth and expansion. This mirrors mixed commentary from US restaurant chains such as Denny's, Wendy's, and Chipotle Mexican Grill. However, both the Consumer Confidence Reading and the Restaurant Performance Index have rebounded strongly from their April lows, reached in the wake of the initial launch of tariffs by President Trump on the so-called Liberation Day. A similar rebound can also be seen in the S&P 500 Consumer Discretionary Sector Index. Overall retail sales seem resilient as well. This matters because consumption drives around 2/3 of US GDP, and this makes therefore the timing of the latest quarterly results from US retailers Target and Wal-Mart all the more intriguing, even if they address different segments and demographics. They will release second quarter results to the end of July, on Wednesday the 20th and Thursday the 21st respectively. Both coughed up profit warnings in the spring, and analysts have fretted ever since about how Trump's tariffs could raise input costs on imported goods and maybe crimp consumer spending power at the same time. Both share prices, though, have rallied since April, so the results and especially the outlook statements for the third and fourth quarters could be instructive. Walmart actually left guidance unchanged after the first quarter, and analysts will use that as a steer for benchmark for second quarter figures and any updated outlook for the rest of the year. For the second quarter only, Walmart expects net sales growth on a constant currency basis of 3.5% to 4.5%. Analysts expect a headline figure for net sales of $174 billion, and that turns into a consensus analyst forecast for the second quarter of $5.8 billion in net profit and a headline earnings per share figure of 72 US cents, up from 67 a year ago. For the full year to January 2026, Walmart has thus far guided to a net sales increase on a constant currency basis of 3% to 4%, and analysts' headline estimates for the top line is $699 billion. Management expects full year EPS to come in between $2.50 and $2.60, and the current consensus analyst forecast is $2.58. In contrast to Walmart, Target lowered expectations twice in the spring, once ahead of the first quarter results and once alongside them. For the second quarter, analysts now expect a 2% drop in headline sales to $24.9 billion and a drop in earnings per share from almost a fifth to $2.08. For the full year to January 2026, Target has thus far guided to underlying EPS between $7 and $9, with gains on litigation settlements taking the stated range to between $8 and $10 a share. Consensus before the gains is $7.55, down from $8.86 in the year to January 2025. Watch out also for any comments on tariffs, shipping lead times, and also the impact of the stronger dollar. It should also be worth looking out at two other numbers besides the headlines and the outlook statements, as they can give extra insight into what may be really happening at both businesses. The first is inventory on the balance sheet, and look at the headline figure, but also growth in inventory relative to growth in sales and the trend in inventory days. Retailing is all about shifting the right products at the right price in the right format to the target demographic. Do that, and the amount of unsold stock will be low and the need to discount to shift it will be reduced. Too much stock can mean price cutting is required, and that can show up in the gross profit and then further down the profit and loss account. The second figure to watch, therefore, is gross margin. This is a useful benchmark for retailers, as weakness here could flag price pressure, input cost pressure, or a combination of the two. Walmart's gross margin looks pretty metronomic, Target's less so. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.